Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, so let's look at the numbers. As of the closing bell on February 11th, 2026, Satellogic Inc., ticker symbol SATL, closed at $3.17 per share. So that's a decline of about 4.37% on the day. And volume came in pretty heavy at 2.72 million shares.
And just to put that 317 print into perspective, for anyone not, staring at a terminal all day, we are looking at a stock that has just punished investors. I mean, a brutal 52-week range of $1.25 on the low end to nearly $6, $5.93 on the high end.
Right.
But the real story isn't just today's drop. It's the violence of the volatility we saw in late January. I mean, we saw that massive gap up to 550 on January 27th, and then it was immediately followed by a sharp, really painful retrace.
Which I think brings us directly to the central question for this session. We're looking at a company with a market cap of roughly $459 million. And the thesis on the table is what I'm calling the 5X thesis. Can Satellogic's vertically integrated model actually drive a five-fold return? Get them to a roughly $2.3 billion market cap by 2036? Or is the market right to punish the stock because the path to get there is just paved with, excessive dilution?
I think that's exactly the right frame. You see a manufacturing breakthrough that, justifies the volatility and the risk. I see a financing trap. The technology works. I'm not going to dispute that. The cameras take great pictures. But the capital intensity required to build a 300 satellite constellation, it creates a dilution cycle that, in my view, makes the stock basically uninvestable for an early shareholder. You can love the product and still hate the stock.
Well, let's start with the positions then. I want to articulate why I believe the market is fundamentally misunderstanding what Satellogic actually is. Most investors look at this ticker and they just see another data seller in a crowded Earth observation market. They'll compare it to Planet Labs or Maxar. But Satellogic is not a data company first. It's a manufacturing company. The core of my argument is this industrial moat.
Okay, define that moat. Because in aerospace, manufacturing usually just means you're assembling parts you bought from someone else. You buy the bus from one guy, the solar panels from another.
Exactly, and that is where Satellogic is completely different. This is the whole logic behind their LF-1 constellation. We aren't talking about standard aerospace procurement where you're just a systems integrator. Satellogic produces these microsatellites, the NewSat Mark V, that weigh about 38.5 kilograms. Inside that small package are like 10,000 individual components and 450 subassemblies. And here's the differentiator. Almost every single critical system, the optics, the onboard computers, the power subsystems, the reaction wheels, even the propulsion, it's all designed and built in-house.
Vertical integration is a buzzword that gets thrown around in every SPAC presentation, though. Does it actually impact the bottom line, or does it just make for a nice slide in the deck?
Oh, it absolutely impacts the most important metric in this industry, CapEx efficiency. If you are buying components, you're paying the markup of every single supplier in the chain. Because Satellogic builds it all, they just strip those markups out. And this integration results in a cost per satellite in orbit of less than $1 million. That's about 1/10 the industry standard. This isn't a marginal improvement of 10 or 20%, it's an order of magnitude advantage. When you can put assets in orbit for $1 million that competitors spend $10 million or more to match, you have a structural cost advantage. That lets you survive price wars that will bankrupt everybody else. That is why I believe the current valuation is just ignoring the industrial reality here.
I appreciate the engineering marvel. I really do. I mean, putting a functional satellite up for under $1 million is impressive. But I have to look at the financial engineering, which I find much less impressive and frankly hostile to the current shareholder. You talk about a war chest. I see a dilution trap.
You're referring to the recent capital raises, I take it?
I am. Let's just look at the data from the last 10 months. April 2025, they raised $20 million. October 2025, another $90 million public offering at $325. And then, right after that share price spike in January of this year, they hit the market with another $35 million registered direct offering. That is $145 million raised in under a year. The share count is now sitting at roughly 142.87 million.
Which is necessary to fund the growth. I mean, you can't build space infrastructure on good vibes alone. You need steel, you need silicon, and you need launch slots.
But at what cost to the equity holder? Let's just break this down for the listener who might be new to this. Dilution isn't just a number on a page. It's your ownership percentage shrinking. So while you see a company funding its future, I see a burn rate that is, well, it's insatiable. Estimates suggest they need another $400 million to finish that 300 satellite constellation. If they keep raising that through equity at these price levels, the share count just keeps doubling. So the company might succeed. Satellogic might become a $2.3 billion company. But if there are 500 million shares outstanding by then, because they had to print so much stock just to survive, the stock price hasn't moved. That's the capital trap. The pie gets bigger, but your slice becomes microscopic.
I see why you're emphasizing the share count, but let's look at what that capital is actually buying, because this moves us right into the core debate about the competitive landscape. You mentioned the dilution, but that capital is buying a capability that peers like Planet Labs or BlackSky, they simply don't have it at this price point.
I would push back on don't have. Planet Labs has a massive archive of data. BlackSky has speed. What does Satellogic have besides a cheaper bill of materials?
They have high resolution at high frequency without the high cost. Specifically, we're talking sub-meter resolution, 70 centimeters moving to 30 centimeters. And for the listener, the difference between 3 meters, which is standard for Planet's old Dove fleet, and 30 centimeters is the difference between seeing a parking lot and being able to count the cars in it, or even identify the type of vehicle. That matters for defense, for insurance, for economic monitoring.
But Planet is upgrading their fleet too with the Pelicans. They aren't just standing still.
True, but Planet Labs is trading at 24 times EV to revenue, with a legacy fleet that requires massive capital to replace. Satellogic is launching this next-gen platform, which is AI first. And let's clarify what that actually means, because AI is a term that's thrown around way too loosely in tech right now.
Please do. Because usually when a company says AI first, it just means they added a chatbot to their website. What does it mean when you're in orbit?
It means edge computing. In a traditional satellite model, you take a picture, you wait to pass over a ground station, you download this massive raw image file, gigabytes of data, and then a server on Earth processes it to find what you're looking for. It's slow, and the bandwidth is expensive. Satellogic's next-gen processes the data on board the satellite itself. It delivers insights like there are 3 new ships in this harbor directly to the ground. This reduces latency significantly. It's a real shift from selling JPEGs to selling answers, and they're doing all this while maintaining that 100% deployment success rate.
Selling answers sounds great in a pitch meeting, but let's look at the valuations, because that's where the rubber meets the road. Planet Labs has trailing 12-month revenue of $294 million. Satellogic is sitting somewhere between, 15 and 20 million. Yet Satellogic is trading at a price-to-sales ratio of around 13.9. That is incredibly expensive. BlackSky, which grew its revenue 32% year over year to $26 million in Q3 2025, is trading at roughly 6.1 times sales. So why would I pay double the multiple for a company with 5% of the revenue of the market leader?
Because you are paying for the growth rate and for the margin potential. BlackSky is a defense specialist. It's a niche.
It's a niche that generates cash. My big concern with Satellogic's moat is the race to the bottom. You claim their low cost allows them to survive price wars. I argue that as Planet, BlackSky, and Maxar all upgrade their fleets, pricing power for standard sub-meter imagery is just going to collapse. If everyone has sub-meter resolution, it becomes a commodity, like buying bandwidth or electricity. And in a commodity market, margins compress. Satellogic needs that 1/10 cost structure just to break even, not necessarily to generate outsized profits.
But that commoditization argument assumes they're selling on the open spot market, trying to sell images to hedge funds or farmers one by one. But that brings us to their big pivot in commercial strategy. They aren't just trying to compete for data subscriptions anymore. They're pivoting to the sovereign government program. This is the quality of revenue argument that I think the bears are completely missing.
The sovereignty pitch, selling nations their own personal space program.
Exactly. And it addresses your concern about commoditization head-on. Just look at the evidence from January 2026 alone. January 12th, they signed an $18 million agreement with CEIA in Portugal. This isn't a subscription where Portugal logs into some website. It's a partnership to deliver 2 Mark V satellites for their Atlantic constellation. Portugal owns the capacity. Then, on January 27th, the deal that caused that huge volume spike, the sale of the Amelia Earhart satellite to HEO in Australia.
Which was an asset sale, let's be clear.
It was a transfer of title, yes. It established Australia's first sovereign sub-meter capability. This differentiates them entirely from a Maxar or an Airbus. Those legacy players, they want to rent you access. They want you dependent on their feed. They're like a taxi service. Satellogic is willing to sell you the car. And nations want autonomy. They want control. They don't want to have to ask a U.S. company for permission to look at their own borders. That creates a sticky relationship that a simple data subscription just doesn't have. Once a country integrates Satellogic hardware into their national defense workflow, they are not switching providers next year to save 5%.
I'm skeptical of the stickiness of asset sales. Let's be honest about the accounting here. An asset sale is a one-off event. You sell the satellite, you book the revenue, and then what? You have to sell another one to keep that growth line moving up? It makes the revenue extremely lumpy. You saw the excitement around the HEO deal, but can they replicate that every quarter? If they don't sell a satellite in Q2, does revenue just drop 80%? I mean, that is a terrifying prospect for a public company.
But it's not just the sale, it's the tail. They maintain operational support. And look at the Albania extension on January 29th. That is a persistent, countrywide monitoring agreement. They converted a launch deal into a long-term recurring monitoring contract. That proves the model works. You get the big upfront payment for the hardware, which helps cash flow immediately, and then you get the recurring tail for operations.
It proves it works in Albania. But let's be real about the financials. They're still net loss making. In Q2 of 2025, the operating loss was $15.8 million. So even with these quote-unquote landmark deals, the cash burn is significant. To justify a 5x valuation, to justify a $2.3 billion market cap, they need to transition from selling hardware, which is lumpy, to selling high-margin insights at scale. And that is a very difficult pivot. They're competing against analytics firms that don't have the burden of maintaining an entire constellation.
But those analytics firms are beholden to the data providers. Satellogic controls the whole stack. But let's talk about the math, because you mentioned the impossibility of the 5x return. I want to lay out the numbers for the listeners so they can judge the feasibility for themselves.
Please do. Let's see if the numbers can hold up to some scrutiny.
All right. To reach a $2.3 billion market cap by 2036, assuming a conservative 5 times price to sales multiple, which is, typical for a mature industrial firm, they need roughly $486 million in annual revenue.
Whoa, which is a massive jump from the $13 to $20 million range they were in during 2024. You're talking about a 25-fold increase in revenue.
It is large, that it only requires a compound annual growth rate, a CAGR, of about 35%. Now, is that achievable? Well, the total addressable market for Earth observation is projected to hit $14.55 billion by 2034. If you look at the broader satellite data services market, some forecasts push past $100 billion. This whole thing is being driven by ESG monitoring, precision agriculture, and border security.
The TAM is large, I'll grant you that. The demand for data is not the bottleneck here. The world is hungry for data.
And analysts are starting to see it. Craig-Hallum initiated coverage in January with a buy rating and a $5 price target. That suggests the market is waking up to this potential. If they hit that 35% growth rate, which is actually lower than the 45% some analysts are forecasting for the sector, the revenue math works.
The math works for the market cap. My problem is the share price. Let's revisit the dilution math I mentioned earlier, because this is where the retail investor gets hurt. You say they need $486 million in revenue. Fine. But to build the infrastructure to generate that revenue, the full 300 satellites, you still need that extra $400 million in capital.
Which they can raise.
But how? If they raise it via equity, they're issuing another 100 to 150 million shares at current prices. So, in 2036, The company is worth $2.3 billion. Great success story. Management gets a bonus. But if there are 300 or 400 million shares outstanding by then, the stock price is what? Roughly $7 or $8? That's a double, maybe a triple over 10 years. That is not a 5x return. And that assumes everything goes perfectly. That's a lot of risk for a 2x return over a decade. The S&P 500 would likely beat that with zero risk of bankruptcy.
You're assuming they finance exclusively through equity at depressed prices. That's a worst-case scenario. As they execute, as they sign more deals like Portugal and Australia, the share price should rise, making future capital raises less dilutive. Or they can tap into debt markets once they show positive cash flow.
See, once they show positive cash flow is doing a lot of heavy lifting in that sentence. They had $22.5 million in cash at the end of 2024. The recent raises pushed them over $100 million pro forma, sure, but the Q2 operating loss was nearly $16 million. That runway is not infinite. They have to execute flawlessly on sales right now, or they are back to the market, hat in hand, crushing the stock price all over again.
I think you're ignoring the gross margin improvement. In 2023, gross margins were 50%. In 2024, cost of sales stayed flat while revenue grew 28%. By Q2 2025, cost of sales as a percentage of revenue dropped to 27%. The unit economics of that 1/10 cost advantage are finally showing up in the financial statements. This isn't theoretical anymore. The factory is working.
Margins are improving, I'll concede that point. But let's talk about the financing and catalyst cycle. We saw it perfectly in January. Good news comes out about the Australia deal. Stock gaps up to $550. Retail investors get all excited. And then, boom, a $35 million offering priced at $473. The stock drops to $317.
That is standard operating procedure for any high-growth, capital-intensive industry. You raise when you can, not just when you have to.
It's standard, but it's painful, and it trains the market to sell the news. Every time Satellogic announces a win, the smart money expects an offering to follow immediately. That creates a psychological ceiling on the stock price. The algorithm becomes good news, sell before the dilution hits. That cycle is incredibly hard to break until they're self-funding.
Or it creates an entry point. If you believe in the long-term structural advantage, then buy on the offering dip like right now at 317 is the strategy. You are buying a company that has already cleared the launch pad. They have 100% deployment success. The technology risk is largely off the table. They aren't trying to figure out if the satellite works, they're just printing them now.
I wouldn't say the technology risk is totally off the table. This is new space. Launch failures happen. SpaceX could have a mishap that grounds the fleet for months. Orbital congestion is real. And what if the next-gen platform has some systemic issue? That 5x thesis just evaporates overnight.
The bet is a risk for the entire sector, not specific to Satellogic. And I'd argue Satellogic's agility, their ability to iterate from Mark IV to Mark V to next-gen so rapidly because they control the manufacturing, makes them more resilient to those risks than a company buying off-the-shelf buses that take 3 years to redesign.
Perhaps. But let's summarize where we stand. I look at Satellogic and I see a technological success, but a dangerous investment. That financing cycle, that gap up, followed by the dilutive drop, is likely to repeat itself. The risk of launch failure, combined with the sheer mathematical weight of dilution, makes the 5x target incredibly difficult for the current shareholder. You might be right that the company becomes a major player, but wrong that the stock is a wealth generator from this entry point.
And I see the current price of $3.17 as pricing in execution risk, as if it were failure risk. The market is treating them like they might go to zero. I just don't see that happening with the sovereign deals already in place. Vertical integration is the only way to survive the coming commoditization of Earth observation. And with the LF-1 constellation achieving what it has, the infrastructure risk is just lower than the market thinks. The moat is real, and once that constellation is fully deployed, the cash generation will be massive.
It all comes down to the burn rate.
I agree. That's the critical metric.
For 2026, anyone listening needs to watch one ratio: the cash burn rate versus the pace of new sovereign contract signings. If the signings outpace the burn, you might be right.
And if they don't, the dilution will continue. But the potential for a fundamental shift in how we image the Earth and who controls that data is absolutely there.
A fascinating case study in hardware versus finance.
Indeed. That does it for this analysis of Satellogic. We'll be watching the ticker.
Until next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.